In this week's update, getting your timing right. What's happening with the rotation trade and precious metals or Bitcoin? My name's Garry Davis, and as always, this is general advice only. And please remember to like and subscribe to the video. Well, I think it's this is the final video for the year, and I think it's an understatement to say that this has been an extraordinary year. There's just really no way to express the change that we've all had to go through, and who knows what 2021 might bring. But let's have a look at where the market sits at the moment. It's, as I said, it's been an incredible year, and it's finished with quite a flourish. We're not quite done yet, and there's really no reason why we can't still get some further gains into the end of the year, the way things are sitting. But look, a key issue here is timing. Markets have been volatile all year. I think that is going to be a feature of what we're going to have going forward, because central banks with their policies are just creating so many stresses in the global financial system that I think it would be unwise to expect that we're just going to get a nice smooth passage forward. So timing when markets are very volatile is obviously really critical. So I want to look at that this morning. And some of the things that we can do to help us time well in terms of entries and exits, both at an overall portfolio level and also at an individual stock level. It's really important to understand the macro environment in detail, and that's just not the stock market, that's the bond market, to a degree it's currency markets, it's certainly economics, and it's certainly geopolitics, because all we've got in the market is balance of probabilities or weight of evidence. And so understanding all of the things that feed into the market sentiment and the market doing what it does, then the better off that we will be. Now, there are certainly mega trends out there that are relatively easy to identify, and if you're involved in stocks that are participating in those mega trends, then that strong growth is going to help overcome any unexpected events that come along, and nothing has really been more unexpected than COVID. And also, if your entry timing is not quite right, then really strong growth over probably a medium term is going to help you get back on the right side of the ledger. So that's why I place so much focus on being on stocks that are involved in the megatrends, rather than trying to pick rebound trades in crude oil or certain industrials or whatever it might be that have got headwinds. Because to me, those businesses are going to struggle most of the time. They're going to have some good periods, but most of the time they're going to struggle because of those headwinds. Whereas if you're involved in stocks that are heavily involved in the megatrends, then you're going to have tailwinds all the time. And that generally means that you've only just got to wait it out a little bit longer, and you'll be able to get yourself back into a good position. It's really important to avoid the media and the group consensus. It's always been the case that if you go with the news and try and trade the news, then you're generally days or weeks behind, and you generally end up far worse off. But the way that it is now, particularly with social media, I think it's even more amplified these days, that if you go along with the group, particularly at the extremes, then you're just going to be on the wrong horse all the time. So it's really, really critical. If you want to time the market well, you've just got to shut all that out, and you've just got to have a plan that allows you to enter and exit at higher probability times. So it's really about understanding your game plan quite clearly, and then executing it. Now, what's happening with the rotation trade? Do we need to change course? Is the rotation trade going to continue to be the best place to be? Is it in fact the best place to be right now? So about 3 or 4 weeks ago in this weekend update, I said that I thought we would probably continue to see money flow into the rebound stocks, the stocks that had been hit the hardest from the global lockdowns. But I also saw the fact that money would probably continue to flow into the technology sectors as well. And so therefore we probably would just see a relatively even balance between the technology stocks or the aggressive sectors of the market and the more defensive sectors of the market that were rebounding. And that's pretty much the way that it's played out. And in fact, in the last week, you'd have to say that the technology stocks have probably done best. So I think the rotation trade has probably run its course. That's not to say that some of those stocks will not continue to rise, but I think we've seen the best of it. Whereas in the mega trends, we've by no means seen the best of it. And that's been the point that I've maintained all along. It's about being in the area where the best long-term growth is. So the mega trends will prevail. There is absolutely no question that 5G is just going to become a more and more important part of what we do, and it's very, that's just one example. There's many examples, particularly in the medical science field, where there are just extraordinary advancements being made. So those mega trends will prevail, and most investors will find it very, very difficult to change horses mid-race. And what I mean by that is, jumping out of those megatrend stocks that have served us so well for many years and, try and play the short to medium term rebounds in, let's say, in energy, for instance. It's very difficult to do that and then swap back again just at the right time. So from my perspective, you just ride out the short periods where there is an interim rotation going on and stay with what's working in the long term. Now, one thing that does concern me a little bit about the market is that there is definitely some irrational exuberance out there, particularly with a lot of the IPOs in the States, with with companies like Uber and those sort of IPOs that are just based on absolutely ridiculous metrics. So that is often a sign of markets that can become a bit unstable. And so I'm fully expecting that we're going to see some fairly savage price movements in some stocks. Whether we see that at the index level or not remains to be seen. But I think what we're going to see is a market that's going to break up into two different areas. There's going to be the stocks that are high growth stocks that have got good underpinnings, and those prices are going to continue to rise. And then we're going to see the stocks that are at ridiculous levels, and they're probably going to be dealt with fairly harshly. So I think there's still going to be very, very good opportunities out there. But, you just need to be careful that you don't come into some of these really hyped stocks too late, because I think there's going to be some savage pullbacks. So use the relative strength is really, really important. I think go with what is working, go with where the strength is. So they're the overall thoughts. I think they've been relevant all year. Nothing has changed as we go into 2021. Now the US market, what an incredible year. The S&P is currently up 15% for the year. And when we look at the chart, you'll see just what an amazing ride it has been. But when COVID hit in February and March and the market was plunging and people thought, life the way we knew it was going to end, it was unthinkable that the S&P by the end of the year could be actually trading 15% up on the year as a whole. So that's really quite amazing. The S&P showing great strength, continues to track along and just above the 20-day moving average, which is a sign of real strength. When you can sustain that level of increase, then that's a very, very strongly underpinned trend. The US dollar continues to fall down to 90 now, and I think might have even dipped under 90 in the last couple of trading sessions. The 10-year yield is still holding in that area between 0.9 and 1%, and that's a really important metric to keep an eye on. So let's jump in and look at some charts. So this is the S&P. This is where the S&P started at the start of the year. January 2nd was the first trading day. Here's where we finished. But look at what happened in the middle. It was just a tick over 4 weeks. from when COVID hit, or when the impact of COVID hit on the market. COVID, of course, was in the news before that, but this is when the market decided that enough was enough in the third week of February, and it just fell apart completely into the third week of March and then turned around. And it took 5.5 months, and it was back to the pre-COVID levels. We then had a period where it oscillated above and below that prior February peak, and it did that until we got into the early part of November, and then we finished the year, as I said, with quite a flourish. And you can see the 20-day moving average is this green line, and the market's still showing tremendous strength. And really impressively is the Russell 2000. So this is the small cap end of the market, and you can see new all-time highs, and just look at how steeply the small cap end of the market is rising. And that's a reflection that the breadth of this advance in the US market is certainly a real sign of strength for the market as a whole. You just don't get this broad-based participation if the market's about to roll over. You see the small caps start to roll over first. So that's a really, really positive sign. Now let's just look at some of the charts that we've been looking at with respect to the rotation trade. So this is the Russell 1000 growth divided by the Russell 1000 value stocks. So you can see when the line is rising, growth is outperforming, and that had been the case all year until we got to the end of August. And once we got the news about the vaccines, then of course there was this sudden rotation in anticipation that all the beaten down sectors would rebound. And that's happened a little bit. But is it sustainable? Look, I don't really know whether it is or it isn't, but I play the probabilities. That's all we've got, and that's all that I do. And to me, once we'd had the initial rebound, I couldn't be confident that the rebound stocks would keep going. Maybe they do, maybe they don't. But I don't like those odds where it can go either way. I would rather stay with something where I can feel almost 100% certain that it's going to continue. And so money has started flowing back into the technology sectors, the healthcare sectors, the consumer discretionary sectors. And as a result, we've now got this balance between the defensive and the aggressive sectors of the market. And this may continue for a little bit longer. But in the long term, I'm still absolutely convinced that the aggressive sectors, the technology sectors, will outperform. This is consumer discretionary versus consumer staples. There hasn't really been that much of a rotation into consumer staples. The consumer discretionary has continued to do very well and is still basically rising. And this is the industrials relative to the S&P. So again, the line rising indicates that the industrials are doing better. And there are some parts of the industrials market that have linkages to the megatrends, and they're the ones that are doing well. Okay, let's move on now to the Australian market. And I'll come back and do the currencies in a minute. So the Aussie dollar went above 76, got almost to 76.5 at one stage. And that's really just the continuation of the drivers that we've seen for the last few months, and that's US dollar weakness and commodity strength. And all the trends continue to be in that direction. As long as the Fed keeps printing money at the rate that they are, then it's highly likely that the US dollar is going to continue to decline. And of course, commodity strength is based on the reflation trade of so much stimulus being put into the system that we are seeing strength in commodities. So 80 cents for the Australian dollar has to be considered a possibility. So if that has any impact on how you trade or invest or move your money around the world, then certainly 80 cents can't be ruled out at this stage. Now our index, for what it's worth, because to me it's not something that I trade, was higher by 0.5%. The small cap outlook for 2021 is still hugely bullish. There's still so many wonderful opportunities in the small cap end of the Australian market. And I'm not talking about speculative stocks or speculative mining stocks, although there are some pretty sensational rises there. But just, really good, solid, technology-driven small caps. There's some wonderful stocks out there. But what we are seeing, particularly in the last couple of weeks, is that this part of the market has become a bit illiquid. It's like everyone went to Christmas early. And, that means we've seen a lot of toing and froing and some pretty disappointing trends, considering what underpins those companies. So that's been a bit frustrating, frankly, for someone that trades both markets, Australia and the US, very actively. The US trends have been, wonderfully sustained, and there's been tremendous outcomes there, whereas the Australian market has been disappointing. But look, I'm sure that's probably just a short-term dynamic, and we'll get back to some of those stocks really showing what they can do next year. So turning now to let's look at the US dollar. So you can see we're still clearly in downtrend. This blue line here is the 50-day moving average. We've broken this support level here around 91.7. We're now getting down close to support around 89.5. Not quite there yet, but from a technical point of view, this is a really important level, this 89.5 level. So I will be just amazed if we don't get some sort of bounce from here, at least temporary. So that will put some downward pressure on precious metals prices and other commodity prices. But look, it could be mild, and it certainly could get outweighed by other factors. So currency is not the only thing, and it's not even the main thing that's driving the gold and silver price. There are certainly other factors there, and the Australian dollar is just really doing the inverse. So a move back towards 80. So we were at 80 in January of 2018, and we're certainly heading back in that direction at the moment. So that's what's happening on the currency front. Turning now to precious metals, gold gained $41, so it was a pretty good week, up to 1881. Part of that is the currency, but the currency didn't really fall that much. There's certainly a lot of other support coming into gold. There are multiple tailwinds for gold to be getting back into an uptrend, and as I said last week, I think I'm comfortable that the correction is over. We won't necessarily see the prices of gold and gold stocks just move straight back up, but they rarely do. Generally, the bottom of a correction in the precious metal space is generally played out over several weeks, and you get multiple opportunities to buy into that sector. So, I'd be looking at progressively building in on weakness into this sector. So there are multiple tailwinds for gold, but look, there's two impediments that I'm wary of. One is a US dollar rally, which is very hard to anticipate in either time or dimension. But you'd have to think that all prices of everything, every asset, have periods of rebounding, some sort of reversion to the mean, and I think it would be reasonable to expect that the US dollar will do that as well. And also there's a real argument developing now about whether Bitcoin is drawing some of the funds that would otherwise go into gold are being drawn into Bitcoin. I really don't know about that. I'm certainly not one qualified to have an opinion on Bitcoin. The only thing that I would observe is that the Bitcoin market compared to the gold market is quite small, and so therefore it's hard to see money going into Bitcoin really taking that much away from the precious metals market. But look, we'll see with Bitcoin. The issue that I have, and we'll have a look at the chart of Bitcoin in a minute. The issue that I have with Bitcoin is that I don't really understand what it is that makes the price do what it does. and therefore what's it likely to do in the future. Whereas I understand that very, very clearly when it comes to stocks. So other than those two impediments, which may or may not have an impact, I think the rally, the end of the correction and the rally that's highly likely to be emerging is underway. And when it comes to precious metal stocks, we are seeing some more positive signs in GDX. So let's just jump in and have a look at some of those charts. So we'll start, just check in on the Australian index. So you can see since we broke out above 6,200, we've just continued to gradually work our way to the upside. And of course, all-time highs in the Australian market occurred in February, just over 7,000 points. Turning now to the gold market. So there's gold on a weekly chart. So we're still sustaining this trend channel that started back in 2018, and we got outside the trend channel in August when gold really took off. We've had our corrective phase. We've come back to multiple points, the bottom of the trend channel, this moving average, and the point where the gold price actually blasted out of the channel. So it's all three of those areas are coming together, and that's proven to be a support point for gold, and quite a nice bounce last week. So if we look at it on a daily chart, you can see it fulfilled what normally happens, and that is we pull back to the 200-day moving average, and that generally is a point where you can look for completion of corrections. If we look at GDX, you can see we also managed to tag the 200-day moving average, and now we're starting to form higher highs and higher lows in GDX, so things looking more positive there. But let's look at Bitcoin now. So this is the chart of Bitcoin. It's just extraordinarily volatile. As you can see, we had this incredible run into 2017 where the price went from 1,000 to nearly 20,000, and then we came back to 3,000, and we've been all over the place, but now we are clearly back in uptrend, and we're trending very strongly. So as I said before, my issue with this, why I don't get involved in Bitcoin, is because I don't know what made the price do that. I have no idea. And therefore, could the price come all the way back down like it did in 2018? Maybe it will, maybe it won't. But I just don't understand the drivers that are moving the share price, moving the price of Bitcoin, like I do with shares. So that leads me to conclude that the only way that you should really be involved in Bitcoin is to trade it with a game plan. Just trade it on technicals only. And have an entry methodology and a profit-taking methodology, and just stick to it religiously. And at the moment, it's had an incredible run. Who knows how much further that might go? But this is, to my eye, from a purely technical trading point of view, this is not a time to be joining the party with Bitcoin. Okay, let's get back to other things. So with commodities, copper was higher to $3.61, so another nice move up. And as I said last week, this is a really good long-term story unfolding with copper. I think for the next 5 to 10 years, things should be pretty buoyant for the price in the sector. Now, crude oil continues to firm up to $49. Which is the highest level since February. So I'm a little surprised, but that's we're certainly getting some short to medium term strength in crude oil. But again, I just don't know how long it's sustainable, and there's too many unpredictable geopolitical events happen with respect to crude oil that it's not one that I get too actively involved in. There's the spot copper chart, so we are now moving towards $4. So to wrap it all up for the year, because this will be the final video for the year. I'd really urge you to avoid being part of the crowd. Whatever you do, don't find yourself being drawn into doing what the media circus is talking about, doing what consensus views are doing. You need to learn to throw some sort of bridle over your emotional biases. And I know it's very difficult to do that sometimes because that's how we're wired. But I know from some of the questions that I get that some people come to the stock market with incredible biases and almost a need for their opinion to be right. And you've really got to get on top of that if you want to be successful in the market. Now, there's every reason to be quite bullish for 2021. I think we are going to see a market that is definitely going to operate in two separate halves. We're going to see stocks that have got headwinds continue to struggle. We're going to see stocks that are being priced on ridiculously stupid fundamentals. I think they're probably going to get some severe treatment. And then we're going to have the other half of the market where they're just really fabulous, unfolding long-term stories with high growth. And that's the area that you need to focus on. And they're going to provide some terrific opportunities for 2021. In the short term, the market has had quite a run, might continue now into the end of the year because that's quite often what happens, a bit of window dressing by the US institutions. But I would just be a little bit wary because so many stocks are in a position where they've got very extensive, deep in the money call options. This is a time of year when market makers can exploit that. So I think in the very short term, and I'm just talking the next few days, just be a bit conservative. We could see a little bit of volatility before a final rush into the end of the year. Now, Portfolio Analyst this week will be the final edition for Portfolio Analyst, and just reviewing the fabulous opportunities in the US. Very exciting what's going on there at the moment. So that's it for this week. That's it for this year. I'd like to wish everyone a terrific festive season and look forward to being back with you in 2021. Cheers.